Chapter 12. The Cost of Capital. Learning Objectives. Compute the component cost of capital for debt, preferred stock, retained earnings, and new common equity. Describe the weighted average cost of capital and discuss the logic of using WACC to make informed financial decisions. Describe how the marginal cost of capital is used to make investment decisions. Discuss the relationship between the firm's WACC and the investor's required rate of return. Cost of capital is the firm's average cost of funds, which is the average return required by the firm's investors. Weighted average cost of capital, also called WACC, is a weighted average of the component cost of debt, preferred stock, and common equity. It equals to the proportion of debt times after-tax cost of debt plus proportion of preferred stock times cost of preferred stock plus proportion of common equity times cost of common equity. There are three approaches to calculate the cost of retained earnings. 1. CAPM. 2. Discounted cash flow. 3. Bond yield plus risk premium. Target capital structure is also called optimal capital structure. The percentage of debt, preferred stock, and common equity that will maximize the price of the firm's stock. Marginal cost of capital is the cost of obtaining another dollar of new capital. It's the weighted average cost of the last dollar of a new capital raised. Breakpoint. Breakpoint is the dollar value of new capital that can be raised before an increase in the firm's weighted average cost of capital occurs. Breakpoint equal to the maximum amount of lower cost of capital of a given type divided by proportion of this type of capital in the capital structure. Key cost of capital concepts. What is the weighted average cost of capital? How is it used to make informed financial decisions? To determine its required rate of return, the firm must compute the cost of each source of fund or capital that investors provide. These costs are then combined by weighting each component by the proportion of weight that is contributed to the total capital of the firm. How is the marginal cost of capital used to make investment decisions? The firm should invest until the marginal cost of capital or marginal cost equals the rate of return or marginal revenue on the last project or investment that is purchased. As long as an investment's expected return exceeds the firm's WACC, the investment should be purchased. What is the relationship between the firm's weighted average cost of capital and the investor's required rate of return? A firm's cost of capital is the rate of return that investors require to provide the funds that are used to invest in assets. Investors will not provide funds to a firm unless they expect to receive returns that are high enough to compensate them for the investment risk they take.